Hello, sir.
How are you?
I'm doing good. How'd that expiration go? There's a big goose egg.
Yeah, a puppy dog today. You never know, but no trades in March today. Settlement at 14.10 off of no trade. So
Oh, they resettle for yesterday's closeout.
yeah, I just looked at time and sales, and that's where they show the settlement. So I'm not sure what the you know what the I guess.
That's the only thing they have to go off of.
Yeah, no, I mean, you really can't judge it off the bid ask here. Let me share my screen. Let's see. And then I've got a bunch of stuff to run through today, so you'll have to slow me down, speed me up, do what you see fit.
All right, no worries. What the heck? We were going to start at 12:10.
Yeah, I got about a minute.
Um,
Yeah, what a difference a week makes just with all the different markets here.
it's interesting on the way in this morning. I always listen to Bloomberg, of course,
Yeah,
and they were talking. There we go. That's what I want. Barry Ritholtz, who
yeah,
I like Barry a lot. He's good. He was just talking about commodities in general, and he said the classic line: the cure for high prices is high prices."
yeah,
It's kind of amazing what high prices will do.
yeah. The old John Maynard, the Keynesian saying, higher, yeah, definitely. But again, fundamentally with crude oil, I'm not sure what it, the market, equities up, crude oil down, life is good. Oh yeah, by the way, 10-year, 30-year notes or treasuries are at surging ahead here. So you've got the FOMC meeting that starts today, tomorrow. So is it a quarter of a basis? Is it 50 point, basis? And we know what's ahead. So, okay, energy prices, everybody wants to try to quantify that the worst case scenario is built in. And I hope so, but that's the problem. It's based upon hope right now.
Well, with the classic supply demand of economics, we have not destroyed any supply yet. This is the Russia Ukraine war. Now, it's highly likely that it's going to get destroyed somehow, but it hasn't happened yet.
Yeah,
So, I mean, I think you got to play that into the cards. What I was kind of thinking, next level, third derivative sort of thing. The beneficiary of this whole war is going to end up being China from a commodity standpoint, because the Russian commodities are just going to flow to China
yeah, at a highly discounted rate because they
at a
can't go anywhere else.
massively discounted
Yeah,
rate.
yeah. Now, and the interesting thing with China, they're going through the the next phase of COVID, where their zero tolerance, zero policy is blowing up in their face. Where that was the headline, one of the headlines I saw either on Bloomberg or CNBC this morning, that global commodities sell off because of lack of Chinese consumption. So
Well, that's the real deal. I mean, there's so many people in that country. That's not far from the truth. All right, let's kick it off. March 15th. Say goodbye to March futures. It's a goner.
yeah, and let me go here. Um, You know what? I'm going to jump forward. I don't know why I moved this. I had it up and then I moved it. So we'll come back to all this other stuff. But we'll start with EFPs. There were 176 coming into this morning. When you look at open interest this morning, there were 24 Marches left on the books. March did not trade today. So we can add another 24 to that 176, and yeah, it's a decent amount of EFPs. We're back to the, obviously below the high watermark set in May and July of last year, but much higher than the last three expirations. Settlement today was 14.10, and Mike and I were just saying that it's a nominal settlement based upon yesterday's close. The only bid ask today was a 13.50.10 bid, 14.20 ask. There were a bunch of trades yesterday. It traded in a range of 13.48. It traded as high as, I think, what did I sell? I sold as high as 14.25, 14.30 yesterday. So obviously you're going to have some mill. You had a mill come in yesterday to sell it, to deliver this, to EFP it, and then you have guys just staying long. Obviously, we're able to buy a substantial discount to where sawmills are today, where West Fraser is still the low man on the totem pole. They're a 1400 out of Alberta. They were a 1420 out of their BC mills, and everybody else is scattered higher from those levels. So for those that do use futures, you did have a chance last week. This week, March did trade sub 1350. It traded all the way down to 1310 last Friday. So for those that wanted to take delivery, EFP, exchange for physical, you had a chance to buy realistically $80 to $100 under mill ask prices for that same wood.
But what is the market? You could have bought 14.10.
Yeah.
No
Yeah.
one, the best bid out there is 13.50, or was 13.50, and no one is selling that.
Yeah, no, I think that's the difficulty, is you probably could talk to 5 people, and where is the market? I think you would conceivably, if you're a Western SPF guy, Eastern SPF guy, if you're able to buy other species, if you're a truck-based guy, car-based individual, you're probably going to get 5 different answers on where the market is right now.
And you know why? Because it's in 5 different levels in 5 different locations.
Sorry, and we'll come back. Here's weekly continuation. So this 1410. Obviously, this is the highest expiration now. You're going to have to go back to really the May expiration level now. And we still have the potential. So people ask, always ask, well, where are the gaps? Where are the gaps? So to the downside, and so when we factor in May, obviously May's trading at a substantially cheaper number. May traded down into the sub 1060 area yesterday. So I'm sorry, in the low like a 1073 area. So there's still a continuation gap at 1069.60 to the downside. And then when you look at the upside, you still have this high bar here of 1514. And then this continuation gap at 1540. So on a continuation basis, you've got a wide trading range in this 1550 area down into this $1,000 area, and everything in between. And then I'm gonna jump back before we get into all this good stuff. We'll go back and start from the beginning now. I think for the promo for this show, we talked about, obviously EFPs and then the other physical commodity markets and how much they can influence lumber. And so if we remember, this was from a week ago. You had energy surging, you had the grain surging, lumber was up 14%. These were 1-month performers as of exactly 1 week ago. And if we flip the page to this week now, this is over that last week period. You can see how crude oil, and this is as of today, was down over 30% off of its highs. It's fighting back a little bit, but front month crude is still down $5 right now. So you can just see what goes up must go down. Mike, you use the phrase, the cure for higher prices is higher prices. And, we kind of had the initial flurry of activity in commodities appreciating, and as of the last week, you've had a significant correction just about in all these physical commodities now. So here's lumber. So on any given day, what does lumber track with? Does lumber track with its own fundamentals? Does lumber track with other commodities? Does lumber track with equities? And the answer is all in the eye of the beholder. How are you trading? Why are you trading this? And for everybody that thinks May's this spectacular buy at this massive discount to physical cash, well, you're in the industry. You have a fundamental justification for what you're doing, but there's also the commodity fund that trades lumber that's getting taken to the woodshed on his crude position, on their crude possession, their metal possession, their grain position. And when they hit the sell button, they're not separating out what they're coming out of. They're coming out of everything. So beauty's all in the eye of the beholder here. And when it comes to lumber, you can trade off of fundamentals, you can trade off of technicals, you can trade off of a lot of different things. And lumber on any given day likes to, I call it the chameleon, and it likes to basically absorb into other things in any given day.
Um, well, and it's also called the professor because over the long term, it would like an 18-month lead that might be shortened up right now, but
Yeah,
generally
yeah.
lumber is an 18-month lead for where the economy could be going.
So here's, I didn't show crude on this chart last week because I couldn't get it to fit within my banding. So a week ago, crude was up in this $130 area. Again, crude today is dropped all the way down. Front month crude, April crude's traded back to 93.50. So you've gone from $131 back to 93.50 in crude. You can see equities, you're really still trying to bottom out here. Uncertain. Lumber has had a bounce as of, and again, this reflects front month crude. So I'm sorry, this reflects front month lumber. So when we look at May, you'll see the corrective move there. The one that really stands out to me though is the purple line, which is 10-year notes, and I'll flip forward here. I'm sorry, here's crude oil. So a week ago we were at 130. Today you got down to 93, massive sell-off in crude. Here's gold. Gold got up to the 2070 area, basically traded back down to the got down to 1908 today. Here's wheat. Wheat traded up to, and this is May wheat, but front month wheat traded up over 1550. You've had a correction back to $10. And so when we jump into 10-year, what do you see on 10-year? Well, last week, the 10-year, the last 2 weeks with the start of the Ukrainian situation, 10-year went from 205 back down to 166. Today, it's back at 212. So you've taken out the recent high in the 10-year. You can see here's you're basically, if you want to go back to 2019, you're at your 50% retracement. So this tells us we can get back up to 250, 275 to 3%. And when you look at the 30-year, very similar here, where you can see how we've come a long way from July of 2020, July of 2021 to where we are today. And okay, what does this mean? Well, here's your 30-year mortgage rates. And you can see from the low setback, the end of 2020, beginning of 2021, basically in this 2.5, 2.6 area, we're back under back under 4%. So you're trending back up into this 4.5, 5% area, which were the highs back in 2018, 2019. So again, the begs the question. We have inflation. We have higher. We know that the Fed has their start of their 2-day meeting today, so they'll make their announcement tomorrow. I think expectation is a 1/4 basis point raise. Some of the more ambitious show 0.5%, but we know the Fed is going to hike rates here 5 to 7%. So how much of that is baked into these rates that exist today? And then the last thing before we jump back into lumber here, here's inflation. Here's CPI, and you can see, what does inflation mean as far as discretionary income? We're back at. We've eclipsed, and so here's inflation. This is your start of your the Gulf War here. This is lumber. This is at the time a big spike in crude oil prices, inflationary sign, start of a recession. We're back to 1980, early 1980 CPI, PPI, inflationary type numbers. So what does that mean? What are these headwinds, not just for lumber, but for the economy in general, moving forward?
Yeah, there's no doubt it's more expensive to be alive right now and just to survive. I stopped by my folks this week, and my dad's pickup truck has a 35-gallon gas tank in it,
Yeah.
and he's lamenting at how expensive it is to fill his truck up. $150 to fill his truck up with gas.
Yeah, and the big thing is this crowd, thankfully, most of the people on this call are lumber traders. So you have unlimited earning potential, especially with lumber at $1,400. But I think what's lost in when you see inflation at 8% to 12%, depending on what metric you lose, is your cost of living. If you're a salaried employee, are you seeing a reflective move in your wage growth to mimic the cost of inflation? So that annualized growth of inflation, the people that benefit off of that are people that change jobs where you've got to be paid fair market value. But are most companies that pay a salary, you get some kind of inflationary adjustment to your wage. Typically that's 3.5, 4%, maybe 4.5%. Well, inflation is significantly greater year over year than that 3.5, 4%. So to say that this doesn't come out of people's pockets somehow, some way, it definitely impacts discretionary spending. It definitely makes people prioritize how you're going to allocate your money, and that not everybody is seeing wage growth is mimicking existing inflation. Um,
And where I think this is going to hit the hardest is in the hardest to detect area, which for lumber, that is, which is the repair and remodel. And, you know, look, if you're going to move and buy a new house, you're going to move and buy a new house. But do you really need a new deck? Do you really need to put that addition on? Maybe you can live with that garage a little longer. You know, it's the things like that. And I believe the repair and remodel was kind of that hidden tailwind that we saw in the spring or the summer, basically, of 2020,
yeah,
when everyone was kind of cooped up.
no, I
So,
think you're spot on, Mike. I completely agree.
so now you have the question: is it a need to have or a nice to have? And in a low inflation market, nice to have is pretty easy to have. But all of a sudden, when it costs you $150 to fill up your truck to drive to Home Depot and buy some studs to put that little addition on to the back of your house, that's a different ballgame.
Yeah, absolutely. And I think all these things add up to where a year ago there were a lot of tailwinds, there was a lot of green shoots out there, organic growth potential when it comes to housing. I think there's a lot of demand that still exists with housing, but I don't think it's as easy today to say that there are all these positives out there that are going to act as tailwinds for housing. I think that there are significantly more headwinds now, more hurdles for this industry to have to jump over to kind of mimic this growth. And so again, it begs the question: we've got a sustained rally in pricing here, and we'll jump into was a good foray into lumber. I'll skip this. We did that. We did that. So here's the price curve from a week ago. Here's March. You stair step down. Here's May. Here's July. We kind of were, leveling out in this 1,050 to 950 area. Fast forward, and we've had a much more severe correction. Now, these numbers were as of this morning. These are based upon yesterday's settlement. We're obviously limit up right now. So, but a week ago, May was in that 1268 area. Today we're back up in the 1160 area, but yesterday May did trade down as low as that 1073 area. And you can see in all these back months now, instead of being in that 950 area, you've had $100+ correction where you're flatlining out in this 800, let's call it, to 900 area. So here's spot, here's cash, here's your inverted curve. So is this real? And all these markets are going to continue to trade higher, to converge at some point in time with where cash, futures slash spot, the cash market is today? Or is this a sign, a leading indicator of what's to come, that this is going to come down and eventually float down to these lower numbers? And that's what we're all being asked to decide day in and day out. Are these numbers here sustainable, or is this a sign of what's to come? And from a buyer's perspective, I want to sell here, so I want to short as many jobs at today's levels, and then I want to cover in futures, pure and simple. I want to sell here and then cover along the price curve and lock in my jobs at these lower numbers.
Yeah,
From the
and I mean,
sawmill, yeah. I'm sorry. I was going to say, from a sawmiller's perspective, it's not that easy, in that their returns are up here today. What's an acceptable return for May production, for July production? It's not that easy when you have to, when you have to sell at these significant discounts to where you're getting, you're selling today in cash.
right, and this chart, while it looks rather stark at the left side of it, tomorrow this is a different chart. That's all gone
Absolutely.
tomorrow.
Yeah.
So,
Yeah.
this I think is one of the most interesting time frames of the lumber year, where you have an expiration, and that expiring contract was, and the cash market is so much higher than the next expiration and the expiration after that. So,
And so, Mike, that's a great point. So here's the continuation chart. It's reflective of March at 1410. When you open tomorrow, May's gonna, excuse me, let's just assume May's gonna set a limit up today at 1160. Well, here's where you're gonna gap down. Here's gonna be your May in this 1150, 1160 area. Oh, sorry. So the argument's gonna be, well, back in January, cash basically went sideways. There was no depreciation in cash. Futures had this massive correction to the downside. You basically liquidated out commodity fund longs. That selling subsided. Nothing changed in cash. Futures raced back up. Not only went back up to the previous high, made new highs. So is this another, basically, is this another repeat of what happened in January, where we saw this correction in futures, nothing changes in cash? So you're going to have May down here, and at the very least, May should trade up to some kind of area within where March expires today. And May's this spectacular buy because cash isn't going to come off, and futures has to converge. And my only argument with that is, futures is futures, cash is cash, and don't confuse May lumber with physical cash. They're two different animals. They're two different things. That May futures, I understand, is a speculative tool and you're buying at a discount. But remember that if you're buying May futures to take that wood to EFP, exchange for physical, or take delivery, realistically, that's the last week of May. That's June 1st wood. That's not today. That May is a stopgap at a significantly cheaper number, but that is not today's wood. That is not prompt wood. That's wood for June 1st. So
well, and
that's
a
the only
conservative
thing I want to point out.
and someone who's running an inventory conservatively, that's not June 1st wood. That's July 1st wood. Like when that's going to be on the ground off the rail car, ready to ship to a job site, that's July 1st.
Yeah, and again, a lot can change between now and June 1st into July 1st. Here's a seasonal chart. You can see we're well ahead of last year's pace to the upside. The red line is 2021. Here's 2022. So you can see, when you look at the kind of previous years, and I should have added a 3-year, 5-year, 7-year average to this, but you can see that typically we top out. As of late, we've been topping out later and later into April and May. Historically, we typically top out into the third week of February, into that third week of March. So March expiration is today. Are we here? I guess we'll find out. Volatility, and I'll run through this pretty quickly, but volatility has come down, but is still relatively high versus its 5-year average in lumber. So we still have high volatility, and that's still seen. Here's rankings of implied volatility with all the different commodities. You can see lumber, July lumber is number 3. May lumber is right here. You still have high relative volatility in lumber. So options still remain expensive, both calls and puts. There's still an elevated level of volatility in lumber, and we continue to see that even with the expansion of the new trading limits, this market is still trading limit up, having limit moves, 3 out of every 5 days, substantially higher than I think the CME was anticipating at this point.
Just on the volatility topic, the one thing I have noticed, though, as I watch the option market trade, is when volatility was increasing, it seemed like the buyers were the aggressors. Buyers were lifting offers. Um, in the last week or so, it seems like there's more sellers who are being the aggressors. Sellers are hitting the bids, which just tells you there's a comfort level with the premium that's coming in, and that premium will be enough to offset the risk of holding that short position in an options contract.
Yeah, I think that's a great point. You saw that. You saw that. In looking at the equity markets, you saw that last week, where you had insane implied volatility in crude oil options, where you were getting ridiculous numbers to sell versus what you would have to buy. So the second that volatility, the second the trend reverses, that volatility goes hard the other way, and just blows up the other side of it. And that's kind of what you've seen play out in crude now, and ultimately what you could see play out in lumber. So here's March. I'm not going to fixate on this because it's basically the continuation chart. This is March. No change week over week. You basically stayed. March did trade down to the 1310 area, traded as high as the 1425, 1430 area. So you basically were in tandem with where the physical cash market is, within $10. The big one here is May. So again, May traded down until its Bollinger Band low, until its 44-day, 40-day. And you can see we tried to break out. Now we're seeing reversal. You're staying above these moving averages. So is this your buy? The reality is, if you're going to close up here, you're going to generate a reversal buy signal today in May. The expectation is, well, May's too cheap relative to how March went off. So somewhere in between lies the truth. Maybe you float back up to 1200, 1250 for starters. Here is May a week ago. May was trading at a $100 discount to physical cash. Fast forward to this morning, you were almost $300 under physical cash. So obviously, it's tough to justify selling something at a $300 discount. Eventually, you bring in the forward buy type people, and that's what you've seen in futures now. So here's May. Here was July a week ago, 243, almost $440 discount to physical cash.
Yeah, let's just post up here for a second. $443 discount. What does this really tell you? Well, first off, you're not going to buy wood, put it on the ground, put a hedge against it for July. Obviously, there's no basis here. That's anybody knows that. What it's telling me is that the confidence level in the end user, which is going to be a developer, is pretty low. That lumber prices are going to stay where they're at. So if you have a project that is going to build in the second half of this year, even closer to that third quarter of this year, you're not buying wood right now. You're just not doing it because there's a massive discount.
And I think I've mentioned this, Mike, that we talk to a lot of home builders, single family, multifamily developers, and they're all engaged like never before as far as covering their own risk. So there's lots of interest to buy that price curve in July, September, November to lock in these jobs. You're not going to speculate and put wood on the ground and inventory it at today's levels. You're going to buy the futures, and if they can lock in their risk, they're absolutely looking to do it. And that's something that's the trading, that missing ingredient that just was never there, is there in full force now with home builders, private equity, and really truly end user types that have to cover their own risk.
Yeah, absolutely.
And so here's my here's September as of this morning, a $500 discount to cash. So these represent pretty good buy opportunities along that price curve for those that are looking to lock in cheaper than today's cash levels. Here's the March-May spread. I'll run through these quickly. A week ago was in that $154 area. Yesterday, it traded out to 250. So it just completely annihilated whatever short stood around that weren't meant to be there. Fast forward to March, May. Here's March, May. This is March, May a year ago. So here's, May, July. A week ago, we were in the 142. It traded out to the 175, 180 area last week before trading back in. I think we traded back in into this 130-ish area. And right now we're back out in the 155 area. This is still an elevated spread where, again, you compare it against last year. Here's March expiration last year. The spread was 90 over. So today's spread has already traded out, basically touched the highs from a year ago. So that just doesn't make a lot of sense why May needs to carry this premium to July. But that's the curve you have right now, where you just have these massive drop-offs from month to month.
Yep.
And open interest a week ago, 24.67. Fast forward today, 23.74. So again, with March going off, we're losing open interest. You see it in the CFTC numbers. You know, what's the missing ingredient? Here's a week ago. Here's today. Managed money stopped buying, pure and simple. The funds stopped buying lumber. You know, so with that inability to make higher highs in May, they basically put away their buy books. And then the other thing, I had somebody ask me, well, where do the where does that home builder developer segment show up in the CFTC numbers? And it's either going to show up in this producer merchant section, or it shows up in the other reportables, depending on how they fill out their CFTC form. If they trade greater than 20 contracts, they're going to get lumped into one of these categories, and a lot of them fall into this other reportable position. So you can see that there's a build. You know, you're starting to build both these long and shorts. You know, my guess is these are industry guys, but not your traditional industry types, more of the, true end user types showing up in the market now. Rail car, slight improvement week over week now. It looks like we've definitely bottomed. We're definitely behind where we should be the previous 2 years, but you are seeing, some kind of improvement. This is Canada. So again, looks like we're bottomed off the lows. And then the US is kind of stumbling around here. And I think that was it.
Yeah, and I actually this week spoke with the Union Pacific. They're busting out some more rail cars out of storage, and they said things are starting to free up for them a little bit. I mean, it's by no means are the rail cars flying around, but it's starting to loosen up from my source.
So did they say that it, weather certainly doesn't seem to be a reason now, just lack of people, lack of resources? Was there any good explanation?
We didn't go that in depth.
Okay.
My experience with the railroad is that it is such an interconnected group that your toe hurts and it causes your hand to move slower, right? That's really what happens.
Well, and so that's the other, reason why May came off the limit yesterday and potentially is back up today, is the idea that CP potentially will have a strike vote, I think, as early as Thursday, where they could potentially go on strike. So that's out there as well.
Something I'd like to just kind of bring up. We're talking pretty bearish about lumber here. There is a bullish case to be made too. It's a little strange to think about, but inflation is going to cause the person who's not working yet to go out and need to work. One of the headwinds for lumber consumption was that we didn't have enough people working and putting these houses together. So I think that the inflationary environment is going to cause people to get off the couch and go back to work, which is a bullish sign for consumption of lumber.
Yeah, and the other thing I'll add to that from a bullish standpoint, and talking to some of the Euro mills and talking to some of the bigger global players, is, well, Russia has put a ban on their Russian log exports to basically Western countries now. So all those Russian logs that were flowing into Europe, into Scandinavia, are obviously going to have to go to China. China becomes the beneficiary. So you probably get less consumption of Russian logs in Europe. So does that mean there's less euro exports to the U.S. where that wood's got to stay in Europe because it's got to replace the lack of Russian logs. The counter argument to that becomes, well, if China's going to consume more Russian logs, they're going to consume less Canadian logs. So it's this vicious circle of, what does it ultimately mean? Where, that could be a bullish case that there's less Euro wood that hits the States in the short term. The longer this drags out with what's going on and there isn't some kind of positive resolution in the Ukraine, I think the ones to watch are corn, wheat, because of their production of corn, production of wheat. You're entering into that window in the next 2 to 4 weeks where they have to plant. If they don't plant, then that's a lost crop for 2022. And the reality is, the longer this drags out in Europe, does Europe ultimately go into a recession this year? That's an extreme possibility, and it becomes more of a probability with each passing day that this continues to drag out. So there's lots of balls up in the air here being juggled geopolitically, globally, and how this all influences lumber. I think this all rolls back to, Mike, that what is lumber? Do you go off of the fundamentals? Do you go off of how the other commodities are trading? Do you go off of equities, the economy? The answer is probably all of the above. It just pick a day, and lumber likes to mimic different things in any given day.
Yeah, absolutely. The knowns out there are we still need a bunch more housing units in the United States, right? Uh, at these price levels, there's no mill in the United States that's going to slow down. Like they will produce. Um, the unknowns are what's going to happen with that supply coming from the Eastern or Western Soviet Union, Eastern Europe. Um, and that's just very difficult. You can't predict that. Um, then the other known right now is if you want to buy wood for the second half of this year, you can pay 50% less than what the current cash market is. No one's going to buy wood and inventory it right now. So there's going to be a massive drawdown of our inventories. In inventory drawdowns, prices go down. That's just what happens because the inventories plus the available supply, we all know lumber is a flat production curve. They make as much lumber as they can every day. You add in the inventory drawdown, it adds more supply than probably relative demand. You're going to see pressure on prices.
Yeah, Mike, I think that's a great point. And, people ask, well, what's your forecast for lumber? And my answer is, I have no clue. Throw a dart at a dartboard. There are forecasting services out there, and God bless them for putting out forecasts and updating those forecasts. The only job that, really in what Alex and I try to do is just define your risk and what's your business look like along that time curve relative to this price curve that we just went over, and define your risk. Is the risk the market going up, down, both, and do something about that risk. And that's the only thing from a risk management standpoint. Define your own risk and do something about it. And that's, outside of trying to project what lumber prices are going to be in 3 weeks, 3 months, 6 months. Your guess is, we'll find out. There's a lot of move. Like we said, there's a lot of balls in the air here, but there's, the one known is that there's a substantial amount of risk, and that's something that you can easily try to quantify and do something about.
And I'll make a flippant remark as well. In the rising market where there was tight supply, everybody had to have a contract. And I put that in quotes because if you have a contract with a mill, it's not papered up. It's just kind of this agreement. Well, in a down market, contracts are extremely painful. And if it comes to fruition, which I see happening, where there's wood in inventory that was put there as a price hedge in that rising market, when that starts to, seep back in or titrate back into the market, on top of your contract, all of a sudden you cancel that contract. The wood doesn't just disappear. Now the mill has to sell that on the open market. So
absolutely,
I think we are going to see a massive cancellation of contracts. and it's going to be very, very choppy and very hard to know where the market is, because it's going to be different in many different regions around the country. And it's the difference between carloads and truckloads is going to be extremely different. So what are you supposed to do about that? Number one, get as much information as you can, correct? Pay attention to what happens in futures. Pay attention to what's happening on materials exchange, where you're getting prompt prices. This, when you look at the magnitude of the spread, $500 a thousand, that's $55,000 on a rail car. One rail car, $55,000 difference between the price today and the price for September. I mean, back in the day, rail cars didn't even cost $55,000.
Yeah.
So,
no, that's good stuff. That's good stuff. And I think, your platform truly, you might not like the price, but that becomes the real market for the buy side, for the sell side. And it's as good when you look at print or you look at some of the publications, there's always argument, well, that's not the real price. Well, the real price is where you can buy, or the real price is where you can sell. And I think your platform, again, gives price transparency, which is key in a market like this.
And if print isn't the real price, then why the hell would you have a contract based off of it? Amazes me. All right, hey, let's talk education. Of course, you got your seminar coming up.
We're still. My shameless plug here. Hang on one second.
Yeah. Is there a limit to the number of people that can go to that?
That's a good question. Am I back? Let me share my screen.
Yeah, you're sharing. You're up there. Okay. You're in Railcar Stats right now.
Okay, so yeah, it's April 27th, April 28th in Kansas City, Missouri, Stone headquarters. Alex Mead with Stone and I will put this on along with Stone Education. We're still waiting on the Stone to give us the exact details where we can save the date out. I think the cost is $300 per person. It's a 2-day thing. It includes dinner, meals, and I'm not sure. I think there's a discount for more than one person coming from a company, but I'll have all those specifics when they put something out. But I hope we get to that point where there is a limit. But again, I'll have more details, and I know there's a lot of interest. Genuinely, I know there's a lot of people have expressed a lot of interest in doing this in person because we can travel now. So it's good stuff, and it basically starts at the 100 level with futures, and then evolves up into that master's level of risk management related to lumber futures with risk management. But it's a good start. It starts at a very ground level and builds up from there with both futures and options. And it's a great course for somebody that's just starting out, but more importantly, somebody that's been doing this a long time. You'd be amazed at some of the stuff that you'll learn, especially from Stone education, on things that you just take for granted, or just you kind of gloss over because you've been doing this for so long. It's truly informative and a good education on using lumber as a risk management tool.
Absolutely. And look, if you want the industry to be better, learn more about other options in the industry and move the industry forward on your own.
Absolutely.
One person at a time. You learn something new every day, and you can help the industry. All right, let's wrap this up. We'll see everybody next week. There's never a dull moment in lumber. Lock limit right now in the front month of May, which is the front month, and July. So what I'm looking for moving forward is going to be, I think we got some price concessions coming in the cash side, but we live in an unknown world. So we're here for you next Tuesday. We'll talk it through, ask questions, get in touch with us if you want us to show you anything. And other than that, have a great, safe week.
I appreciate it, Mike. Thanks, everybody. Take care. Have a good week. Happy St. Patrick's Day.
Oh, of course. Yes.
Yeah.
Bye.
Take